Understanding macro drivers for currency pairs is essential for traders aiming to capitalize on global market trends. Major currency pairs like Euro-US dollar and US dollar-Japanese yen are influenced by a blend of fundamental factors such as economic growth divergence, carry trade flows, and political risk. Firstly, GDP divergence plays a significant role in currency pair movements. When the GDP growth rate of one country significantly outpaces another, investors typically favour the stronger growing economy's currency, driving its appreciation. For example, if the US economy demonstrates robust growth whilst the Eurozone experiences stagnation or recession, investors will likely buy US dollar and sell euro, causing Euro-US dollar to decline. Conversely, if Eurozone growth accelerates unexpectedly whilst US growth falters, traders will likely shift towards the euro, pushing Euro-US dollar higher. Next, carry trade flows significantly impact currency valuations. Carry trades involve borrowing in a currency with a low interest rate and investing in a currency offering higher yields. For example, historically, traders have often borrowed Japanese yen due to its persistently low interest rates to invest in higher yielding currencies like the US dollar or emerging market currencies. Such flows typically weaken the lower yielding currency, in this case the yen, and strengthen the higher yielding currency, impacting the USD-Japanese yen pair. However, traders should remain cautious, as abrupt shifts in market sentiment or economic conditions can reverse the carry trade flows quickly, creating volatility. Political risk also profoundly influences currency pairs. Uncertainty around elections, referendums, or geopolitical tensions often increase volatility and weakens a currency. For example, during Brexit negotiations, the British pound experienced heightened volatility and appreciation against major currencies as markets adjusted to political uncertainty. Similarly, geopolitical tensions involving major economies like the US or Japan can lead to risk-off sentiment, influencing currency pairs like US dollar, Japanese yen, with investors often seeking safe haven currencies during these turbulent times. Political developments can also interact with other macro factors, amplifying market movements, particularly when policy uncertainty aligns with economic vulnerabilities. Additionally, traders must monitor monetary policy closely, as central banks' decisions significantly impact currency pairs. Interest rate differentials driven by central bank policies can amplify currency movements, often closely intertwined with carry trade dynamics. Traders typically scrutinize central bank communications and forecasts for clues about future policy directions, making it critical to understand how these expectations shape currency valuations. Finally, currency traders should incorporate broader market trends, such as commodity prices or trade balances, into their analysis. Currencies tied to commodity exporting economies like the Australian or Canadian dollar can experience significant shifts in response to global commodity price movements, impacting related currency pairs. To navigate these macro drivers effectively, traders should closely monitor economic data releases, central bank decisions, political developments, and other global economic indicators. Combining these fundamental insights with technical analysis allows traders to better anticipate currency movements, manage risk efficiently, and seize trading opportunities in dynamic market environments.